We'll go ahead and get started. My name is Matt Jenskow. I'm an investment strategist here at Waddell and Associates. And thanks again for carving out some time for us, and welcome to this special live edition of our weekly Strategic Insight. Our mission at Waddell and Associates is simple. We enrich lives by providing clarity, and right now that clarity feels quite timely. Markets are moving quickly day after day, and with uncertainty abound, it's easy to feel a bit uneasy. So that's why we felt it most important to connect with you directly today. If you already subscribe to our weekly Strategic Insight, you're probably familiar with our analysis of market and economic trends. And today is supposed to be a live version of that blog. And it's an opportunity to hear from our CEO and Chief Investment Strategist, David Waddell. David has several decades of experience in economics and investment strategy and is regularly featured on CNBC, Bloomberg, Fox Business, and he was just on CNBC last week for a few hours on one of the best market days in quite a while. So today, David's going to walk us through what's unfolding in markets, how we're thinking about it, how we're looking at strategy, and what it all means for you. We believe in showing up consistently and communicating during uncertain times like these. And by doing that, we hope to bring a bit of calm to the chaos. So without further ado, a quick housekeeping note. If you have questions you haven't already submitted, you can drop them into the Q&A box. We've already got a lot of questions lined up. So if we don't get to yours, don't worry. Someone on the team will follow up with you. So with that, David, I will turn it over to you.
Matt, thank you. Great introduction. Good morning, everybody. Thank you so much for clicking in. You know, as Matt said, our purpose in life is to enrich your life by providing clarity. Rarely have I seen an environment so opaque. As such, I felt like, well, I know you always read the Friday email, which I guess comes out Sunday. I write it Friday, or Matt does on occasion. Well, I know you always read that. I think it's better sometimes get a view of some body language, have some dialogue. And so this is a good opportunity, I think, for us to do this broadcast live. We will have a recording of it. You will receive it over the weekend if you want to watch it again or forward it on to your friends. This particular moment in time was something that we somewhat anticipated coming into the year. You'll recognize the motif on the slide. Our 2025 outlook was basically that the animal spirits coming into the year were a little too high. We thought economists and investors and consumers' expectations were a little high. And so we said that we probably have some issues with Trump's tariff policies, that we weren't necessarily fearful, but they were perhaps a little bit more cautious than the street. Well, obviously that turned out to be quite an understatement. And the reason why I've called this the Trump tariff two-step and have this picture of Trump is best described using the following story. This past weekend, after watching the Sunday shows, I decided to take a walk in Nashville, and there's a bunch of construction happening, like always. And there's a brand new bar that opened up on Broadway. It was open for brunch. And I walked in and went to the second floor, and there's a huge line dancing hall. And what I recognized was that the woman that was leading the line dance in the front of the room was very happy and twirling all about and kicking and looking very composed. And that all of the tourists that were surrounding her were all wildly confused, bumping into each other, looking kind of foolish, with some of them just leaving the dance floor altogether. And to a certain extent, that kind of felt like an analog for where we are today. Trump seems to be smiling and dancing, and everybody else is confused, running into each other, and some people feel compelled to leave the dance floor altogether. So my hope today, and it shouldn't take too long, but my hope today is to get you feeling a little better choreographed and maybe a little better in tune with the music of the day. So with that, let's go ahead and get started. All right. Before we begin, let's put a little bit of perspective around the trade issue. This slide shows you that total GDP in the United States of America is about $30 trillion. Of that, consumer spending accounts for $20 trillion. Private domestic investment, which is companies investing in things and people buying houses, accounts for $5.3 trillion. And then government spending, this does not include transfer payments. The entitlements actually show up in consumer spending because it's kind of like wages and consumption, accounts for about 5 trillion. Net exports only really account for about $1 trillion negative contribution to GDP as a whole. So while it feels like today the entire US economy is simply about trade, that's not really the case. We actually import about $4 trillion worth of stuff. We export $3 trillion worth of stuff, mostly services, because we're a high-end design-oriented economy. Which leaves us with a $1 trillion trade deficit. That trade deficit amounts to about 3.5% of GDP overall. So trade is a big deal, but it's a far smaller deal than consumer spending, government spending, and business investment. When you look at contributions to GDP, there's a line in economics that says, as goes the US consumer, so goes the US economy. That was definitely true last year and has been for quite a while. Last year, the economy grew at 2.8%. The consumer contributed 1.9% of that. The government contributed 0.73. The domestic companies and investments were about 0.6, and trade detracted a little bit over 1/4, maybe 1/3 of a percent. That has basically been the case for the last 50 years. We have been an import nation for 50 years. This is not something new. But the way Trump sees it, and he's not necessarily wrong, we do have a problem. And that problem is what economists call twin deficits. First of all, we borrow money to fund the government, as you know. We're currently running a budget deficit of about 6.5%, which is pretty large. And if you look at the chart that I've just popped up, you can see that deficit has been growing since it was balanced, actually back in the year 2000, specifically victimized by COVID, the great financial crisis. But we haven't really regained our fiscal legs ever since. So we have to borrow money to run the government. And if you look at our export sector, we run a trade deficit there as well, meaning we have to borrow money to fund that import consumption. So we run two deficits. We run a fiscal deficit and we run a trade deficit. That's called twin deficits. And what that's led to over a long period of time is a whole lot of national debt accumulation. Now, alarmists will tell you that our debt is $36 trillion, and that's a huge number. What they don't do is adjust it for the size of our economy. So as I just showed you, the economy is about $30 trillion. If the debt is $36 trillion, then debt divided by GDP is about 120%. That's a lot, but basically in line with where we've been post-COVID. During COVID, obviously GDP fell. We had to take on more debt to fund all the stimulus programs, and we actually hit a high of about 135% at the time. So we've actually scaled down debt to GDP since COVID, but it is a problem. It is structural, and there are ways to address it. So the president and Congress can come together and they can cut spending. Clinton did. They can increase taxes. Obama did. They can cut entitlements, which nobody's been willing to do, or introduce Donald Trump's campaign to liberate America by taxing foreigners. And so, as you know, on April 2nd, Trump took to the podium within the Rose Garden and announced that it was now Liberation Day. And the consequences of that were definitely significant. When we came into the year, we expected, because Trump had talked about setting up the External Revenue Service, that there would be an increase in tariffs across the board. We thought Trump's strategy was probably to raise tariffs from 2%, where they were in 2024, to about 12%, and use that 10% rate to fund his tax cut. Those of you who know a little bit about parliamentary procedure here in the United States might recognize that you can't really use an executive order and a bunch of tariffs generated by it to offset in the reconciliation process tax cuts. But as I said in the email, majorities have their privileges. I figured they'd just find a lawyer and work it out. So we expected tariffs to go up by about 10%, specifically to offset the continuation of the Trump tax cuts from 2017. Well, that's not what occurred. On Liberation Day, the reciprocal tariff rate took up the total tariffs as a percentage of all imports to about 28%. Now, it's important to understand that when Trump talks about reciprocal tariffs, erase that from your mind. This isn't about offsetting other countries' tariffs on us. In fact, there are several countries that don't have tariffs on our exports, and there are 27 countries overall that we actually run trade surpluses with. Nonetheless, we put a 10% universal tariff on all of those countries anyway. The way that Trump thinks about trade is if you have a trade deficit with another country, you are being ripped off. So I don't consider these rates reciprocal rates. I consider them what Trump considers a ripoff rate. Now, obviously, the markets reacted wildly after he put a 28% ripoff rate on the global trade economy. And I'll walk you through the mechanics of this, but that led Trump to do a little bit of a two-step and reduce tariffs, taking away the reciprocal ripoff rate tariffs, leaving the 10% installed, and then, raising tariffs on China to 145%. Now I think it's 245%, basically outlawing imports from China. Markets actually did appreciate the concession. That was a de-escalation at the margin. That is positive. But at 24%, the current rates that Trump has out there are twice what we expected, and our rate was higher than most. Now, if you put that bigger rate on the global economy, there are going to be intended consequences, which you draw up in the war room, and then there are going to be unintended consequences that come as a surprise. Which portion of the following was intended versus unintended? I'll leave that for the game theorists, but there's certainly several that caught many people by surprise. First of all, this is the highest level of economic uncertainty we've seen since this department started tracking this way back in the 80s. This is higher level of uncertainty than we saw during the great financial crisis when, remember, we had to issue a blank check and Bush went on TV on a Sunday night and declared that, the economy might be over. So that dwarfs the uncertainty we're seeing today. And then obviously COVID, the pandemic was terrifying and we didn't know whether we were going to survive physically, let alone economically. Well, the Trump 2.0 tariff confusion, which is, I guess, the art of the deal, page 1 is create chaos. That has occurred. This is the highest level of uncertainty we've ever seen for economic policy. And that's led to a collapse in consumer confidence. In fact, according to the Michigan Consumer Sentiment Index, this is the second lowest reading in the history of that index. And just to, articulate the inflationary risks here, the inflation expectations for consumers are the highest they've been since 1981. So higher than they were at the peak of the post-COVID inflation, highest going back to the 80s when we started out at 15, 16, 17% levels of inflation. So real concern about the growth in the economy, real concern about the inflationary threat of all these tariffs. That is known as stagflation, and that's not by any means a good economic situation. Although I will say what consumers think and how they spend tend to be a little bit in conflict. And so this doesn't portend a collapse in consumer spending, but it is certainly a collapse in consumer confidence. And, Trump sort of says in this trade negotiation that they need us more than we need them. Well, it's true that they need us to buy their stuff, but we need them to buy our investments. So there are really linkages here where we're codependent. For instance, Foreigners, those outside the United States of America, own 20% of our total equity market. That's 20% of our total stock market. They own 30% of our total treasury market, so they're helping us fund our government. They own 30% of our total corporate credit market, and that's money that we borrow, we use it to make investments, we get a higher return than we would without it, and then we pay off the debt. You know how that works. And so we do rely on investments from foreigners, and let us not forget, the US would not exist without the investment of foreigners. We did not pay for the Mayflower. This was an investment that a foreign nation made that actually seeded the entire United States of America. The question is, can we get a higher rate of return using that capital than we could without? And we have. That's why pre this event, household net worth was at record levels. That's why GDP per person in the United States is $70,000 compared with $13,000 a year for China. We have benefited from this flood of investment. And part of the reason this investment comes to the United States of America is not only because we're a good rate of return for them and we're prosperous, but we also have the reserve currency in the US dollar on the planet. And confidence in the dollar is mission critical. Now, the dollar can raise in value, the dollar can decline in value over time, but it represents 80% of transactions around the globe. It is the reserve assets within the central banks around the globe. The dollar is the bedrock of the global economy. Now, there have been a lot of stories out there that maybe we're being considered no longer the reserve currency. I take issue with that because the plumbing is the plumbing. And if you were going to displace the dollar with something, it can't be Bitcoin, it can't be the euro, it can't be the yuan, that's a closed market, it can't be the yen. There just is no other alternative. But at the margin, confidence in the dollar could lead to dollar decline. And that is what we've seen. So since the Trump two-step on tariffs began, or the threat of it, we have seen the dollar index decline. And this was updated a couple of days ago, but we've basically fallen 10% in the US dollar from our most recent high levels in the year. And that has created some interesting tensions. So for instance, typically when the global economy or the US economy goes into periods of distress, what you'll see is you'll see money flood into the United States. You'll see the dollar rise, you'll see people buying treasuries, and you'll see yields fall. That is the natural progression when fear strikes the global economy. In this situation, the unintended consequence is we've actually seen people pull out of the treasury marketplace, be they hedge funds, be they individual investors, be they foreign governments, whatever the case may be. But what that's meant is that the dollar has actually fallen, opposite of what you might think, and yields on the 10-year have actually risen since Liberation Day, even though people are forecasting a higher level of recession in terms of odds than they had pre-Liberation Day. So this is a bit of a conundrum that we'll come back to. And those recession odds have surged. So early in the year, and this is Polymarket, which is an online, odds making service. So there's real money behind these opinions, but it updates faster than anything else I've got. Nonetheless, at the beginning of the year, the Polymarket odds for recession in the United States in 2025 were about 20%. Post-Liberation Day, they got up as high as 70%. Trump did a little tariff two-step, and now we're around 53, 52%. So odds of recession based upon the tariff regime, based upon investor oddsmanship through Polymarket, are better than 50% that we're headed into recession. And that, of course, has driven earnings estimates lower. I know this chart's difficult to read, but basically what I'm showing you here is what analysts were forecasting through this period of time for earnings going into 2025, the first quarter, second quarter, third quarter, and fourth quarter. And you can see at the end of 2024, the analysts predicted that each quarter of 2025 would see 10% plus earnings growth. That's very exciting. Got the strategists very excited. Well, since then, and since the installation of the Trump tariff two-step, we've now gotten into this, cascade lower in earnings expectations where 2 quarters are projected to be slightly above 2%. And as these get updated, I expect those to waffle lower as well. So there's been a dramatic markdown in analyst expectations for earnings in 2025. And this, of course, led to a dramatic markdown in the value of the stock market. At its low, off of the high, going into March 9th, the S&P 500 was down almost 20%. That would be a full-blown correction. And the Magnificent Seven, which we warned about in the outlook could turn into the Lag Seven, was down 30% on that day. There's since been a rebound, but you can tell the markets are still queasy as of yesterday, a little bit of a rebound today, and they're still in distress. And so higher bond yields on the 10-year put pressure on downforce on valuations, and higher recession odds put downforce on corporate earnings expectations, which mix together and push stock prices lower. And we said during the outlook that we thought that Wall Street had gotten too optimistic coming into 2025. We finished last year at 58.81 on the S&P. The median target estimate for Wall Street analysts and strategists for 2025 was an S&P of 6,600, which suggested that we'd see a gain of 12% on the year. We took the under, expecting that it would look a little bit more like 2018, where Trump was playing with tariffs, the market was uncertain, and we kind of crabbed sideways. We did have a big correction mid-year 2018 that was resolved by the end of the year, but it ended up being a slightly down year overall. That was the framework by which we were establishing our investment strategy. Well, they've since eaten crow a little bit. They've taken their estimates down for the S&P by 750 points. No longer do they expect a 12% gain on the year. They now expect a 1.4% gain on the year, which we think at this point is much more realistic. All right. So with that at the backdrop, the question is, and this is what I get as I'm wandering around, although I will pause just to congratulate you, our clients out there. I'm not sure how many tuned in today. We serve over 1,000 client families nationwide. And I haven't seen as much anxiety from this within our family as I've encountered outside. Hopefully that means we've done a better job of communicating, or you recognize that long-term financial plans contemplate market volatility. And so sometimes the market's up, sometimes the market's down. But as long as the probability of your financial plan being successful already pre-calculates that into your probability, it really doesn't impact you. It's just an irritant of the day. So anyway, I'm been surprised at the resiliency of all of you across the client base, and just want to congratulate you on that. But nonetheless, there are concerns. And by the way, if you can afford to pay somebody to worry for you, you should do that. And know that there are plenty of sleepless nights at Waddell and Associates, and I've had several of them recently as I'm noodling through all of the probabilities and permutations and portfolio options. So it's hard not to sleep, but I hope that you all are getting sleep knowing that we're taking those sleepless nights and putting them to good use. So with that as a sidebar, what in the world do you do now? Well, recognize, as I said earlier, we have reached pretty extreme levels of uncertainty and fear. So the uncertainty index, which I showed you earlier, is kind of an attitudinal index. This is actually a volatility index that traders put money behind. And so we have seen higher levels of volatility. We saw it during the tech wreck in the late 90s. We saw it during the great financial crisis when the VIX spiked significantly. We saw it obviously during COVID when the VIX spiked pretty high. We actually saw this, if you remember, in the fall of last year when the Japanese carry trade started to run over. We used that as a buying opportunity with cash. This period, we're back to above 50% on the S&P 500 volatility index. That's an extreme level of fear, maximum fear within the marketplace. Well, historically, these moments make better buying opportunities than selling opportunities. What this chart does is it says, okay, what are your returns going forward if you buy when the VIX is over 47 versus when you buy at all other VIX levels? So when you buy at the point of maximum fear, in the 1-year time frame historically, you're up 36% a year later versus 12% for other periods of volatility. When you buy maximum fear 2 years out, you're up 56% versus 25% for all other levels. And then 3 years, 58, you see the trend. Let's go all the way out to 5 years. If you buy at those points of maximum fear, on average, you're up 133% 5 years out versus 74% for all other purchase levels within the VIX. And so this again reinforces that be greedy when others are fearful and be fearful when others are greedy, which is how we were at the end of 2024. So maximum fear equals maximum returns. Also, went back and looked at how big a decline did we just endure. So if you look at the decline over the 4-day period post-Liberation Day, it came in at 12% on the S&P 500, which was actually the 12th largest and fastest decline in the post-war period. The largest being, Black Monday, where after that 4-day stretch, the market was down about 30%. And then you see October of 2008, which was right about the time that Lehman failed. Market was down 18%, 17% during that time period. Then you had COVID. Market was down 17% in those 4 days. And then down at the bottom, number 13 was when WorldCom failed. Market was down 12%. And so the most recent decline was very large, very rapid in history. What happens going forward? Big declines often lead to big advances. Now, these advances are 1 year, 3 year, and 5 year forward. I am not suggesting that this economy or that this market goes up 50% over the next, 3 weeks. I think traders end up trying to whip around within these market. Investors have longer time horizons, have the opportunity to do a time arbitrage, take advantage of short-term trader pain for long-term investor pleasure, and that's what we're showing here. So if you take those rapid declines and you go forward a year, 3 year, 5 year, just like you've seen with the VIX, the returns are substantial. And so if you'd have bought after all that carnage in the worst of it, which was Black Monday in 87, a year later, you were 28% higher. 3 years later, you were 55% higher. 5 years later, you were 119% higher. And those numbers are reflected similarly across those other periods of stress. So big declines lead to big advances. And on the 9th, as Matt referenced, I happened to be in New York in a cab, headed to CNBC headquarters to be on the set of Power Lunch, and Trump did a little bit of a two-step and put a pause on his reciprocal tariffs, my rip-off rate tariffs, and the market had its third biggest one-day gain percentage-wise in history from a total value, index level gain. It was actually the largest that ever occurred. And things were nuts at CNBC. It was really fun. But the rally happened because the market was so oversold. It was so pessimistic. It was so, lugubrious is the best word, that even a whiff of good information could unlock a substantial rally. And that's typically how these recoveries begin. So biggest one-day gain since World War II, which was a total surprise as predicted. And what happens after you have a market gain like that? So going back to those previous bear markets, in 2008, there were some crazy gains. For those of you who were with us at the time, you remember we were tax trading during those periods. It was crazy. Well, there was a 12% one-day gain in October of 2008 after that Lehman Brothers collapse. Government came to the rescue, market got excited. Well, that wasn't the extent of the forward gains. If you look 1 year later, 3 years later, 5 years later, the same patterns persist. In fact, I went through and averaged the forward returns 1 year later after a monster gain like that, and they're 38%. Am I forecasting that? Not necessarily, but we are certainly higher today than we were at the low we reached on the 8th. All right, so I think there are some reasons for optimism, and I think that the stability, relative stability you've seen, at least we've bounced off the lows, the stability you've seen as of late is earned, and let me explain why. First of all, going back to Polymarket, I said, what are the odds that Trump cuts taxes in 2025? Right now, the investor community thinks there's about 91% chance that Trump's tax cuts pass. Now, remember, some of this is just status quo on about $4 trillion, but there's also another $1.5 trillion that got through, I guess, some of the procedural wickets for the reconciliation process. And so there is an additional amount of tax cuts in there, which would count as fiscal stimulus. Now, some will say, well, Doge is on the other side of that, and that's true. But if we're going to get $1.5 trillion in addition to the $4 trillion extension, we're going to get $1.5 trillion, and Doge has cut supposedly $150 billion. The stimulus offsets the contraction activities with the government like 10 to 1. So I'm not worried that Doge is going to somehow limit the expansion. If those tax cuts get through, that is fiscal stimulus, and that's good for investors. And here's the other thing that happened. Nobody really noticed, but last week we got a March read on inflation that came in at 2.4%. If you take housing out of that, the CPI was really 1.5%. Remember, the Fed's target is 2%. So inflation, structural inflation, continues to dissipate and is getting really close to the Fed's target, which puts them in rate cutting mode. Now, coming into the year, the market expected that the Fed would cut rates 4 times over the next 12 months. Or excuse me, 2 times over the next 12 months. Now, even with the threat of the tariff inflation, the market expects the Fed to cut 4 times. That's 2% out of the Fed funds over the next 12 months. We all know tariffs are inflationary, so why would they increase the prospect of rate cuts over the next 12 months? Because, and Powell talked about this yesterday, he views the tariff inflation as largely temporary. Now, I know when you hear Powell, temporary, and inflation, all of that brings up bad memories, but he's not wrong, right? So if Trump passed a 10% tariff and, I buy a pair of Italian shoes and the price of the Italian shoes goes up 10%, it's not going to go up 10% again unless he raises the tariff further. There might be some distortions within the economy and inflation expectations, and he acknowledged that. But really, tariff adjustments in prices are temporary. The bigger risk is that those adjustments lead to recession. And so therefore, we need some Fed stimulus to support the economy. So we're going to get fiscal stimulus through the tax cut, which is not going to be, overwhelmed by Doge. We're going to get interest rate cuts most likely from the Fed. And even with the information the forecasters have today, they see more Fed cuts on the horizon than they did at the start of the year. So monetary stimulus and fiscal stimulus. All right. So let's be Donald Trump. We're sitting in the Oval Office. What does it take to make a trade deal? Well, remember that Donald views any deficit with a country as a loss. So deficits are for losers. So the way you win is you reduce the deficit. It's not about getting rid of their tariffs or anything else. It's just trying to get rid of their deficit. So let's get familiar with our top 10 trading partners and figure out what their deficits are. We run the largest trade deficit, not surprisingly, with China. We run the second largest trade deficit with the European Union, followed by Mexico, which is picking up a lot of China's flow, followed by Vietnam, picking up China's flow, followed by Taiwan, and then Japan. Okay, if you take the top 5 countries that we have trade deficits with, that's 90% of the problem. 90% of the problem. So there's a lot of fanfare around the fact that Trump will be negotiating with 180 countries on the planet. Doesn't really matter. Zimbabwe did cut their tariff rates, by the way. So we're off and running. But 90 countries and 90 days, that's not really important. What's really important is what's happening today, and that's that Japan is in the Oval Office. Now, Japan and China are not really friendly, and so Japan would probably be willing to make a trade deal and wouldn't necessarily just become a port of exchange with China to route goods to the United States of America. Plus, as a good friend of mine reminded me, we also support them militarily, and so they have some incentives there. So let's just get into a negotiation with Japan and see what's possible. All right, Trump set a rip-off rate for Japan at 24%. So let's assume that's the bogey for negotiation. He wants to reduce the trade imbalance by 24%. Well, if he ascribes a 10% universal tariff, which I think will probably stay on, now we're only dealing with a 14% problem. And if you do the math, that ends up being a $20 billion burden that Japan's got to figure out how to deal with. Well, how do they deal with it? Buy American. Why don't you buy some of our liquefied natural gas? You know, the world geopolitically is a very reckless and scary place. You need more defense spending. And so why don't you buy some of our defensive goods? And also, it would be nice, you know, if you would support the American farmer and commit to buying some agricultural products. Why don't you figure out how to do that with $20 billion and we'll call it a trade deal. And that would be a win for America, and it would get Japan off of or out of the frying pan with the rest of the countries. The other thing I think Trump would love to see is that the Japanese would strengthen the yen. The reason we have a trade deficit is, number one, because we're rich. We're a lot richer than everybody else. Number two, our currency, because we are the reserve currency on the planet, is overvalued. And so go back to 1985 when Reagan pushed James Baker within the Plaza Hotel of New York to meet with the G7 or the G5 at the time to figure out how to get the US dollar down. Baker walked out of there with what was known as the Plaza Accord. The US dollar depreciated 40% over the next 2 years, and that helped fix what they saw as a problematic trade deficit through the willingness of our partners. There have been some whispers that Trump would like to do a Mar-a-Lago Accord, whereby countries would agree to the devaluation of the US dollar, which of course would make imports more expensive, exports cheaper for the buyer, and could also help rectify the trade deficit. So I think the recipe to get trade deals done at Donald Trump's desk is, one, just acknowledge there's going to be a universal tariff. We're going to have that because we're not going to touch entitlements, and so we got to get revenue. Number two, you're going to have to come with some purchase orders. Trump wants you to buy American things, so just buy some American things. And number three, consider what's possible with your currency, because any gestures toward strengthening your currency would also help theoretically deal with the trade imbalances. So this is what we're going to be listening for as the trade negotiations with Japan go forward. And if they do, and these are the elements within it, then that's a template for other nations as well. All right. How does all of this filter into the market? For those of you who watched the Outlook, you'll recall this chart. For those of you who didn't, go back and do your homework. So in year one of a bull market, average bull goes up 36%. The current bull went up 18%. Year two, the average bull goes up 20%. This current bull went up 40%, basically caught up to the average of all the post-war bull markets. And then what happens in year three is you typically get a digestion period. In the average bull, it's 8%. The current bull, we were actually well above that. Now we're well below that in terms of where we are on trend. I still expect this ends up being somewhat of a sideways year while we move through all these tariff issues. And so do you take the year off? Should you sell? Well, just because it's a sideways market doesn't mean the market can't advance going forward. Because remember this, it is still early in the game. This chart chronicles the previous, 12 bull markets or so, and how high they ran and for how long they ran. And this is where you are now. this is still a very young bull market when compared to history. And also, even though markets may decline in terms of overall returns in the third year, they also tend to accelerate coming out into year 4 and year 5. Walk forward with me 18 months. Let's say we got a bunch of trade deals done, we got a tax cut, we've got lower interest rates. That's a pretty good environment for the US economy. So if we can avoid recession, which I think we can, we go through this period of digestion and then we're off to the races again. So here's the 2025 bottom line revised edition. Equities, I still think we can end the year moderately higher. It just depends upon how committed Trump is to getting this trade deal done. China's very resourceful. They're stimulating their economy, which is actually good for the global economy. And so remember, while we're 25% of the global economy, everybody else is 75%, and they're trying to figure out how to use fiscal and monetary stimulant to prop up their own economies during this Trump two-step. That's bullish. So I think there's enough stimulus perhaps in the system that we can muddle through. In terms of size, those purchase orders hit his desk. That means that the mid caps are really the ones who are going to be beneficiaries because they're the ones that make stuff. In terms of style, that goes back to being financials and industrials and materials and what's required to make things. I think the value style, which has been outperforming, continues to outperform. In terms of domicile, I think the US has an advantage, but remember this, if Trump's policy is to get the dollar lower, that means foreign currencies go higher, and that adds lift to investments that US investors hold overseas. And so I actually think there are two ways to win here. International has the advantage right now because the dollar's gone down 10%. If it goes down even further, even if their earnings are less for whatever reason, they can see additional lift. So I see internationals performing well. In terms of the US dollar, Trump wants it weaker, says he wants it stronger. His activities dictate otherwise. We thought it would be stronger on the year. I think if he'd have done 10% tariffs, it might have been, but with the current havoc he's wreaked, I think weaker dollar is probably in store. In terms of US interest rates, we said they'd be higher for longer. I don't see, even though the Fed is going to cut on the short term, I don't see the long-term interest rates really drifting lower, and I'll tell you why in a minute. In terms of bonds, investors are going to get their 5%. If you look at the bond index through yesterday, it was up 2.25% already. So there's turmoil in the bond market. Stay in high quality, but I think you get your 5%. In terms of the primary threat, we said that it would be Donald Trump running faster than the markets and the economy could handle. Is Trump going to run off a cliff is the question of the day. And here's why I don't think he will. Because I think this is the disciplinarian. On March 8th, when the tariffs kicked in at midnight, the US Treasury yield, which typically goes down in times of chaos, had gone all the way up to 4.5%. Now, this happened in the UK, and Liz Truss ended up being fired as prime minister after only 44 days in office. Now, we don't have the ability to fire Trump that quickly, and I don't think Trump would resign. But Bessent, who is his Treasury Secretary, understands the markets, understands confidence, understands how important it is that yields don't spike, especially since he's the chief salesman for US Treasury debt. So my conspiracy theory is Trump did want to reindustrialize America, thought he had a plan for it. Lutnick and Navarro were in his ear. He thought, we'll just do this and we'll build some factories. Treasury yield spiked. And I think Bessent walked into his office and said, I'm going to resign if we don't get some control over this, because I'm not going to take the reputational risk of being a Treasury Secretary when you're taking Treasury rates and running them through the roof, right? We're not going to have that UK kind of moment, at which point I think Trump pivoted and said, you're right, let's make it about trade negotiations. And so here we are. So if the 10-year Treasury starts levitating again, I would expect Bessent gets right back into the Oval Office and says, you need to de-escalate a little bit here. And if you'll notice, they've tended to push him forward, which I think is the right decision for the administration. So lots going on. My hope is that that trailing 45 minutes gave you some more clarity on the situation we're in today. I'm not sounding the all clear, but I am saying that maximum fear typically turns into maximum returns. And with that, I'll open it up for questions.
Thank you, David. Very insightful as always, and well timed at 45 minutes there. We do have a few minutes for some questions. David, I think this one is really important in light of a lot of the tariff talk that you just ran through. So kind of game this out here. I'm a small, to mid-sized business owner here, maybe in Nashville. I've got some other buddies that own some small businesses. What do you see the impact of tariffs being on a business like mine that might be small versus some of the larger public corporations or maybe some of the mega caps?
Yeah, I mean, times like these are particularly difficult for small businesses. Number one, because they typically don't have the profit margins that large businesses have. Number two, they can't pay lobbyists to go up there and call like Apple did. Apple called the White House and said, you can't do this to us, you can't do this to us. And he said, okay, we'll exempt electronics. Well, if you're running a small business reselling clothes made in Asia or in China specifically, you don't have the ability to call Trump the way that Tim Cook has the ability to call Trump. I do think that you've got to pass forward as much of the tariff inflation and rate increases as possible. You don't have the ability to realign your supply chains nearly as quickly. And so I'd be the first to raise prices, not the last to raise prices. In these kind of environments, if you get into fights with less astute competitors who cut price or don't pass forward the tariffs, then they end up taking all of that as margin compression, and it's a little bit of a self-inflicted wound, I think. So, you're just going to have to test the marketplace. I might take down less inventory, or, hopefully you had the foresight to load up pre-tariff. If you look at the economic statistics, that's what a lot of people did across the economy. We may have negative GDP in the first quarter because so many people imported so much stuff before the tariff shock hit. So hopefully you were able to do some preparation, but it's tougher on small businesses than large businesses. I watched the bankruptcy filings. That has ticked up. It was sort of headed higher, but not worrisome. Now I expect to see more of that. But when we went through this before with COVID, there was government relief. Maybe there will be some for small businesses, but you've just got to navigate the environment as best you can. And I think it's unfortunate that the policy has been so, significant that it's led to this much pain. And it's much harder being a small business than a large business. You just got to grit your teeth and get through it. Hopefully you can work with your customers and they'll give you some grace.
And to piggyback on that question, let's say I was a small business owner, I didn't see all this tariff nonsense coming, and with this seemingly ever changing policy or decision making kind of coming out of the White House or Washington D.C. right now, as a business owner, kind of how do I think about balancing growing my business with having to deal with some of those rising input costs or supply chain risks?
I think there are times to play offense and there are times to play defense. It's not time to pivot yet. And you should always have a little bit of insurance policy. I mean, we've been at this game at Waddell and Associates for a long period of time. And when your accounts go up, our fees go with it. And when your accounts go down, our fees go down with it too. So we've had to make sure that we run this business with enough profit margin to be able to handle extreme environments like COVID, the great financial crisis, and where we are today without having staffing impacts, et cetera. So there's a little bit of hygiene that you should always have as a business to sort of anticipate these sort of events. I think the time to play offense will come. I think for now, do everything you can to preserve your customer base. There will be those that are your competitors today that if this carries forward, if we do enter a recession, will not be your competitors tomorrow. And that gives you the opportunity to pick up market share. So I don't think now is the time to hit the gas. You can't hit the brake, but maybe stay on cruise control, play it a little cautious. I do think Trump will start making deals, things will start opening up. But we've basically made imports from China illegal, and they've kind of done the same thing. That's a big dent in the global economy, given the fact that we're the two largest economies. And it's going to take a little while to sort through the significance of all of that. So I think the time to play offense is when the competitors are on their heels. I don't think we're there yet. So continue to play it conservatively until either it gets worse or it gets better.
And switching gears kind of from business owner hat, let me put kind of my investor hat on. A common question we're getting right now is now a good time to put some cash to work in the market? And then kind of second to that, if I'm already invested in the market, how can I get more perhaps into stocks? Is that selling some of my bonds? Is that maybe taking some of my checking or savings? How can I accomplish some of those things?
Well, I have three macro answers to that, and I'll let you, Matt, kind of talk through what we've done so far year to date. My first macro answer is if you've done the financial planning correctly, you have an asset allocation. That asset allocation may say I'm 60% stocks, 30% bonds, I'm 10% cash. And don't forget, you've got real estate and other assets that aren't bouncing around. So what bounces around in the equity market gets all your attention, but you got a whole lot of other things on your balance sheet that are doing just fine. So first thing is, if you've got the proper asset allocation through the financial planning process, it pre-contemplates the market volatility, stick to your asset allocation. If things get out of whack and your stock allocation is low, then shave off some from your bonds, shave off some from your cash, and take your allocation back to where it should be. And just like, after times of robust gains, you might shave it down. So rebalancing your asset allocation once a year makes some sense. In extreme moments like this, it's good to revisit it. That's number one. Specifically to the equities market, if you read our email, our strategy has been that we expect the market to be volatile and sideways. The way to take advantage of that volatility is when sentiment gets to extremes, like we saw in the 8th, put some money to work. If the AAI bullish index gets below 20%, or you see the VIX over 45, those are signals that there's maximum pessimism, which I've shown you can lead to maximum returns. And the third thing I would say is that in the event that you make a purchase decision and it moves against you and you've got a tax loss, go ahead and harvest it. So the playbook that we've put out there in the weekly emails is the playbook that we're acting on our own behalf. And Matt, I'll let you take a minute just to walk them through, since you preside over the trades when we make them, kind of what we've done in the portfolio to reflect that so far this year.
Yeah, and that's a good segue. Another question that we get often along those lines is, what are we doing, to protect client portfolios, for our clients that are actually listening in? And it's a good question. And David kind of gave a good answer on, number one, if you are a client, check in with your wealth strategist on the financial plan. And then on the investment strategy side, if you think back almost 2 months to the day, S&P 500 closed at its all-time closing high on February the 19th. And so about 2 weeks before that, and I'll try to say this in the most compliance-approved way possible, but 2 weeks before that, we made a couple of portfolio changes specific to our public equity strategy, where we, as part of what we were kind of forecasting in our outlook a couple months ago, was it reduced our Magnificent Seven equity exposure. So like NVIDIA, Meta, all those companies kind of took our gains in those positions, and then positioned kind of barbell approach for the outcome of the second Trump administration, which we've kind of detailed is potential for reindustrialization of America, or also on the other side of the coin, playing more defense in the event that we see some cracks in the economy. GDP obviously estimates have come down, and recession odds have spiked. So those specific portfolio changes, if you're a client, you need more information on it, feel free to reach out to your wealth strategist. But those are things that we've done over the last 60 days or so, to protect client portfolios specific to the equity strategy.
And then furthermore, was it, Matt, the 8th that we did a tax trade to lock in some losses to help with tax bills, reinvested the proceeds, and rode the rally right back up on the 9th?
Exactly. So on the 8th, we had the big market shakedown. And what you were kind of talking about earlier is what can you be doing in environments like this is tax loss harvesting your portfolio. And that's just a really fancy way of saying take positions that have lost money, they've got existing capital losses, you can realize those losses and buy a similar position. And we did that we did that last week, and we're able to capitalize on the gains on the 9th. So those are additive to sort of total return because it's taking gains out that you're not going to have to pay taxes on this time next year. And for our residents in Tennessee,
yeah. And that's how you make lemonade out of lemons. And those of you who were clients in 2008 will remember we booked so many tax losses that year that clients didn't end up paying taxes for years. And then they started paying them again, got mad at us. But that's one thing you can do during this period in taxable portfolios.
Yeah, it's a opportune time, but like you said, kind of making lemonade out of lemons sometimes. One additional question we got, I think is a good one to kind of harp on is, and it's not necessarily a question, more of a comment, but overall, David, I'm looking at my account. This time it feels different, unlike maybe COVID or maybe great financial crisis, or maybe even Trump 1.0 kind of volatility in 2018. I'm not sure we're going to recover. Do you have any thoughts on that, or what would you say to that?
Yeah, we're absolutely going to recover. And do not forget this. This is extremely important. The news cycle is all sucked into the Trump tariffs, and rightfully so. That's where the action is. But the build out of the AI infrastructure is still occurring. These slides are gorgeous, and Nicole's done a great job with them. But in the past, she might have to hand sketch some of this stuff. Now you can go in the AI, you can tell it what you want the motif to be, and then she adds a bunch of art to it, but it pops up the most amazing slides we've ever had. AI is happening everywhere, and it's happening at a rapid pace. And so remember, when we were talking about the economy going into this year, we said, let's start with what we expect productivity to do. And we expected productivity to be, call it 2% or so, 2.2%. And we expected Trump to levy 10% tariffs, which we expected would deduct about 0.4% from GDP. And then we thought deportations might subtract another 0.1% or so. So GDP growth on the year would end up still being, call it 1.75 to 1.9%, pretty close to our long-term growth rate in GDP, because the upforce from this technological cycle is significant and it's still there. So structurally, this economy is getting an upgrade as we all upgrade our technological capabilities, which means higher profit margins, better labor utilization, add into that, dexterous robotics, and you basically got virtual humans helping us out there. So the power of the technological cycle improvement is significant. What Trump is doing with trade, we'll see how it all plays out. But I don't think that it's negative enough to overwhelm the positive forces from maybe the largest technological upgrade cycle we've ever seen. So no, this is not the end. This is an adjustment. And don't forget, this started with an executive order. This can end with an executive order. And then we go back to right where we were before that executive order, which was the salad days, if you recall.
We've got time for one more question, and this is to kind of piggyback on what you were just mentioning. What sectors or perhaps asset classes do you think will benefit from this current environment and potentially the wide range of outcomes, whether that is like executive order, this goes away, or we kind of continue on in this sort of tariff nonsense?
Well, I mean, the question is, what are the executive orders targeting? If you're a steel fabricator, then you're pretty happy about this. If you're in the shipbuilding business in the United States of America, you're pretty happy about this. If you're General Dynamics and you make defense-related munitions, then you're pretty happy about this, because likely what will happen is that the foreigners will come to the table with purchase orders and want to buy planes, trains, and automobiles from the United States of America. If you're in the liquid gas business, you're probably pretty happy about this. If you're a farmer, it's a little bit of a challenge, but know that farmers are beloved in Washington. And so there have already been some concessions, likely some subsidies. And if the purchase orders from China come through, then there could be large purchase orders of US agricultural products. So I think the people in the industries that are deemed as nationally vital and significant can see benefits. Some of the industries like autos, it's just a mess. We'll see how all that plays out. And some of the industries like pharmaceuticals that look good today, he's talked about putting tariffs on pharmaceuticals going forward. There are pharmaceuticals, some other commodities, copper, lumber, et cetera, that are in this 232 box where we're examining the tariffs. That's where he put the semiconductors, and then we'll think about whether to deploy them or not. So the unfortunate thing about what's happening in Washington right now is it does put the Oval Office into a position of picking winners and losers. If you're Apple, you won last week. If you're not Apple, you had a difficult week. And so that part of it is a distortion, certainly within the economy, but there will be winners and losers. From an investment standpoint, I think for us, it's about investing over periods of time, 1 year, 3 year, 5 year, 20 years. And in those longer periods of time, this just ends up being a blip. So it's uncertain to see who the winners and losers will be. But if you figure out what Trump wants, it sort of lights the way.
Well, thanks, David. As always, insightful, and appreciate your time. And for everybody else, that's all the time that we've got for now. David, I'll let you kind of do a final sign off. But for everyone, if we didn't get to your question today, we'll make sure someone on the team follows up. And if you have any additional questions, please reach out to your wealth strategist. And if you don't have one of those and you'd like to have an initial conversation, please head over to our website at www.wealthstrategist.com to connect with us. We did record the session today, and we'll send out a replay in the next few days. And you can also find it available on our website, like I mentioned, wealthstrategist.com.
Well, I'll just close by saying two things. Number one, I'm not going to show you how to two-step, but my hope is you do feel a little better choreographed, maybe a little bit more confident, and maybe a little bit more in tune with what's going on. Number two, I meant it when I said it earlier. If you can afford to pay somebody worry for you, do that. We are living and breathing this right now. Step forward, made some predictions, risky to do, I know, but using the best of our resource capabilities and research to get you some answers. We'll continue to flood you with content during periods like these. We're not going to hide under our desks. We're going to be right in front of you, holding your hands, doing everything we could do to enrich your life by providing clarity. I hope that's happened today. It's a major gesture of confidence for us to be entrusted with your wealth and the product of your hard work, and even generationally in families. And so we're forever grateful for that. Thank you for tuning in, and have a great long weekend.